Most people have heard that investing is the best way to accumulate wealth. But what is investment, really? Investment is the act of redirecting resources from being consumed today so they may create benefits in the future. More precisely, investment is the use of assets to earn income or profit. The wealthiest individuals in the world became wealthy through successful investment of their assets. Let's go over the basics of common investment methods. Stocks and bonds are two of the most popular forms of investment. A stock represents ownership in a public company. Stocks can be risky because their prices can fluctuate dramatically and unpredictably. However, the bigger the risk, the bigger the potential reward. Stockholders can make money in two ways: dividends and capital gains. Dividends are profits paid out 4 times a year to shareholders. The size of the dividend depends on the company's profit. Capital gains occur when a stockholder sells their stock for more than they originally paid for it. If they profit, it's a capital gain. If they lose money, it's a capital loss. Stocks are traded in markets called stock exchanges. Brokerage firms or apps offering brokerage services make it easy to trade stocks today. A bond, on the other hand, is like an IOU issued by a corporation or government. By buying a bond, you're loaning money in return for a guaranteed payout later. Bonds are usually more stable than stocks. Bonds have 3 components: coupon rate, maturity date, and par value. The coupon rate is the interest rate paid to bondholders. The maturity date is when the payment is due. The par value is the amount paid at maturity. For investments to work, an economy needs a financial system, a network that transfers money between savers and borrowers. Savers and borrowers are connected through financial intermediaries. These include banks, mutual funds, hedge funds, and pension funds. A mutual fund pools the savings of many people and invests in various assets like stocks and bonds. Hedge funds are private organizations using riskier strategies for potentially massive profits. These are usually for the wealthy and experienced. Pension funds provide income for retirees or those injured, funded by deposits collected from employers. The best investment strategy is diversification, spreading your money across different assets to reduce risk. Start investing early in life. Time is one of the greatest assets for growth. This is because of the power of compounding, earning returns on both your initial investment and its accumulated interest. Let's compare simple and compound interest with an example. If you loan $10,000 at a 5% annual simple interest rate for 5 years, you'd earn $2,500 in interest. The total repayment would be $12,500. Now, if you loan $10,000 at a 5% annual compound interest rate for 5 years, compounded monthly, you'd earn $2,833.59. The total repayment would be $12,833.59. Compound interest is far superior to simple interest when it comes to growing your money. Finally, remember, higher potential returns often mean higher risks. In the next tutorial, we'll discuss one of the riskiest financial tools, credit cards. Keep learning, keep investing wisely, and see your wealth grow.